What 2026 will hold for your money? Let's ask our panel. Everyone here at Post 9 today. FundStrat's Tom Lee, Hightower Stephanie Link, and CIBC Capital Markets Chris Harvey. Tom and Steph, both CNBC contributors. One and all, it's good to have you right in front of us on the desk today. All right, Tom. So 2023, we turned in 24%. 2024, we turned in 23%. Pretty good this year, too, 17%. Next year, we fill in the blank with what sounds reasonable to you.
I think it's still possible to have a double-digit year. There have been 12 times in the last 100 years where markets posted 3 years of 20% gains. This year hasn't finished yet. Globally, half the time, markets do even better in the following year. So I think next year is a year where the debate's going to be, is the bull cycle over or is it going to extend? I think it's going to create quite a lot of volatility in the first half, but I think GDP growth stronger. We have a dovish Fed. Valuations are reasonable, so I think we end up exiting very strong.
Why a lot of volatility in the first half then?
Part of it is the Trump tariffs could get overturned. There is a possibility of an extended government shutdown. The nomination and then confirmation of a new Fed chair is going to take 3 months. That could be very controversial. I think all of that happens in the first half of next year.
How's that sound to you, Steph?
I mean, I think that sounds really great. The economy is on solid footing. We've been talking about that all year long. Last week, we got some really encouraging data with regards to weekly jobless claims. Inflation came in a little bit better. We've talked about the H8 Federal Reserve loan growth, lending. That's actually at a 9-week high, all-time high for loan growth. That's very bullish for activity overall. The industrial metals are at all-time highs. And you have global central bankers, including the Fed, getting more and more closer to the neutral rate. That's a good thing. And Fed cuts take a while. There's a lag impact, and I think that's going to bode well for next year. And then you have the one big, beautiful bill. $150 to $175 billion going into the consumer's hands, going into corporate America, so CapEx continues. You add it all up, and I think you have double-digit earnings growth. There are some numbers out there that are a little high, like 16, 17% in earnings growth. I'm not there, but I do think you're going to see low teens.
Mr. Harvey.
I think high single digits is reasonable. Single. I can't get to 10%, 12%, 15 just yet. Right. One of the things that Tom said, I agree with wholeheartedly. The first half, you're going to see a lot more volatility than you have seen in a while. I think people are sleeping on the macro risks, be it USMCA, be it the transition with the Fed. If you listen to Powell, now he wasn't cocky about this. He was very humble. But basically what he said is, I'll see you at the book signing. We have growth higher. We have inflation lower. We're back to neutral. We don't need to do anything from here. And 6 months, if you don't cut rates for another 6 months, that's an eternity in the financial markets. And then the last thing is, I think corporations are going to, after a good year this year, they're going to manage down expectations. As you manage down expectations, that puts a little volatility to the marketplace. And lastly, risk is priced very, very expensively, either in the equity markets or the credit markets. It doesn't take much to upset the apple cart.
You want to respond to that? Because it seems like if not a step-by-step counter in some respects to your view, it certainly is enough of one. I mean, there's going to be more volatility. We're underestimating, maybe too complacent about macro risks that are out there, among other things. What do you say?
I mean, I feel good about the macro environment, all the things I just said. And I think it is a consumer that has been resilient. We've been talking about the consumer forever, how they have hung in there. Yes, it's the high end, not the low end. That tends to be the case on a regular basis, unfortunately. I don't think the AI infrastructure CapEx cycle is going to change in 2026, and that's fueling about 3/4 of the GDP growth. And I do think that we always have a wall of worry. And I've said it, you've heard me say it, Scott, I worry when I don't worry, because that means that we're complacent. I think there's a lot that people have on their minds. I think we're going to be able to get through it because fundamentals at the end of the day, they run the show. And if you do have an economy that grows 2.5%, 3%, we're growing north of that now. But if you have an economy that's growing 2.5%, 3%, typically that's been a 10% earnings growth. And I think we're going to be a little bit more. And you have lower interest rates. By the way, you have lower gasoline prices. You have lower egg prices.
But address the valuation issue that stocks are. You want to go there?
Well, it's all about earnings, though. It's if I think if earnings are growing in double digits, then I do think the valuations are very attractive, especially in other sectors beyond tech.
Yeah, and we have to keep in mind the equal weight S&P 500 PE is 17 times. It's lower than it was 5 years ago. So the market actually has derated in the last 5 years because of these black swans of the shutdown, inflation surge, fastest Fed hikes in history, et cetera. So actually the equal weighted market is cheaper. I don't think risk is actually that expensive.
Listen, so let's turn it to small caps for a second, just talk about risk. There's two indices for small caps, Russell 2000, S&P 600. Both small cap, they should perform pretty much in line with each other. Russell 2000 is outperforming by 8% this year. Russell 2000 outperforming by 8% because S&P 600 is a high quality index. The things that don't earn money, the things that have excessive beta, all really driving that marketplace. So I see, if you look at IG credit spreads, less than 80 basis points. If you don't know that market, that is tight, right? If you look at the S&P high beta index, it's up 35%, 34, 35%, double of what the S&P is. I see a lot of froth, right? There's a price for risk. It's here. I think the price for risk is down here.
Interesting. I mean, it is one of the key questions, no doubt, is whether the broadening story that we've been talking about has legs. And what do you need to reach some of the loftiest targets from strategists that are out there? I mean, the top one's 8,100. Dom Chu joins us now. I mean, it's a nice range, Dom.
It's a big
81's the top, as you show right there.
Yeah, that's right. 81's the top. That's John Stoltzfus over at Oppenheimer right now. So that implies a pretty decent-sized gain. And the lowest is still bullish, only about maybe 4 or 5% higher than current levels right now. But that's Savita Subramanian over at Bank of America. So 7,100 is the low end of the 15 strategists that we've surveyed here at CNBC. 8,100 is the high end. The middle, 7,629, actually implies upside of just about 10% or so from the current levels that we're at right now. So generally speaking, we could get to, if we get to the average target price, a double-digit gain for the S&P 500 by the end of next year. As for whether or not we can see the contributors for that move higher, yes, it's always been about Mag 7, but these days we're seeing a little bit more relative strength in other parts of the market that imply maybe a broadening out trade. Check out the small cap ETF, which is already up 21% on a year-to-date basis. The mid caps are up about 11.5%. Underperforming, though, the S&P 500 at 15. So the small caps getting some legs and some steam that could bode well for the broadening out trade. As for the sectors that could be interesting here as well, check some of these out. Because over the last 3 months, it has been healthcare, financials, and industrials that have been among the star performers on a 3-month basis. So do they carry some relative strength or momentum over the last 3 months into the early part of 2026? That's going to be key as well. As for some of the individual industries that are leading the way higher, speaking of the broadening out trade, the XME is the Spider Metals and Mining ETF. That's already up about 89% so far just this year. The ITA is Aerospace and Defense, which is 51% higher. And the NASDAQ Biotech ETF has been a standout, up 30% so far. So as we talk about the broadening out trade, some of the best performing industries and ETFs out there that track them are not tech or comm services related. There are other parts of the market, so that's going to be a real key for that trade in 2026, Scott. And by the way, for more on that story, just head over to cnbc.com/pro. Subscribers get all the context and detail around those big calls out there. I'll send things back over to you, Scott.
Yeah, that was great stuff, Dom. I appreciate you for that. That's Dominic Chu. So you've already had a good amount of broadening. The idea that the market hasn't been broad is a fallacy, really.
I mean, yes and no, because when you look at 3-year stacked, it's still Mag 7. And so I think it makes sense to not just look at 2025 by itself, but how have stocks done since the end of 2022. To me, there's a lot of room for cyclicals to really outperform, including financials, because the ISM's been below 50 now for almost 3 years. That hopefully turns up above 50 next year, and we get a pretty, I think what I consider a cyclical broadening of the market.
To outperform tech?
Yes, and Steph and I were talking about this, that I think tech earnings visibility is still good, but the multiple expansion story doesn't have as much upside as industrials or financials or energy or even basic materials.
It's funny because you just bought more Meta.
I did.
Like this morning or yesterday,
I did,
right?
this morning, yeah. I still like it very much. It's still down 6% from its highs. I still think that they win from AI and what it's going to mean for their ad business and for their messaging business and customer apps business. The metaverse cost cuts are $5 billion in savings annualized. Gives them $2 a share, again, annualized in earnings. I think this company can actually deliver $36 to $38 a share by 2027. That puts this thing at 18 times earnings, and it's growing earnings at 20% and revenues at 26%. All that being said, so it's a big position, top 5. All that being said, I am underweight other MAGs. I really only own Amazon, very small Microsoft, but I do think that financials are going to be the sector leader next year because we're not pricing in, on a valuation point of view, we are not pricing in all the deregulation that is going to come and the excess capital that is going to be returned to shareholders and, by the way, lead to loan growth, which is why I look at the H8 data. It's really important to see what banks are doing. If the banks are lending, that's going to help the entire economy as a whole us grow, and these stocks are not expensive. Capital One is at a 12 times multiple. You know, even Morgan Stanley, expensive, right? 17 times. Bank of America, 1.4 times book. I think that there's a lot of runway left to the financials, and that's the sector that I've been overweight for a long time, and I continue to be.
You agree with that?
We like parts of the financial. We really liked the financials about a year and a half ago. Now we're just being a little bit more selective. I agree with some of the broker-dealers, some of the credit card companies, relatively cheap. I think there's some upside.
But not the big banks?
The big banks are fine. I just don't think they're an overweight at this point in time. Right? They performed exceptionally well. Actually, JP Morgan's outperformed a big section of tech over the last 3 and 5 years. So it's performed, right?
Well, why wouldn't you be overweight that group? I mean, if you think that earnings are going to stay strong, the economy is going to be good, you're going to get more deals, you're going to get more IPOs, all of that, deregulation and everything. That feels reasonable to expect all of that.
It's reasonable. I think a lot of it's in the price. I think they need to either pull back or consolidate. And if they do either one of those, we'll take a look at them. But I agree with Stephanie. The deregulation story has more to play. But in the banks, I just don't think it's the right time to do it. They perform so well. Valuation is fine. The underlying fundamentals is fine. But there's nothing undiscovered there where we're saying, got to own the banks.
Well, we haven't had a net interest income cycle in about 10 years. And the steep yield curve will be very beneficial for that.
Yeah, but I thought you talked about yields coming down.
We're seeing a steepening in the yield curve.
I know we are now. But I mean,
that's very positive.
Well, because the front end of the curve's coming down because on expectations of rate cuts.
That's okay. I mean, rates are coming down on the short end. Probably 10 years kind of sits here. Maybe it goes down a little bit. But I still think you're going to see a steepening yield curve. And that will help a big part of the bank's earnings, which is almost 50 to 60% in some big banks' cases. That's their revenue generation. So I think earnings estimates are going much higher, and that's why I want to be overweight.
All right. Well, yeah. You guys.
I was just saying, just to add to Stephanie's point, I think tech-forward banks that are using AI also are big margin stories because employee compensation is their biggest expense. I think banks are going to look more like tech stocks in the future, where they use AI to reduce employee dependency and earn the same money and their multiples go up.
All right, well, speaking of AI, one of the critical questions is, can we get past all the bubble banter talk? Well, bubble banter, really. Kind of redundant if you say banter talk. Deirdre Bosa joins us now with that critical question because we're obsessed with it now. I wonder what early 26 is going to bring.
We're probably going to be obsessed with it for some time, right, Scott? I mean, the AI trade, for now at least, in the last few days, back on its feet, but none of the big questions actually went anywhere. This data from SimilarWeb, it gets at one of the most important questions in the whole trade, OpenAI versus the Google AI universe, not just on models, but across the stack and what each one represents. Now, from January to November of this year, OpenAI gave up a little bit of market share. Google, though, grew its market share from about 6% to 15%. This suggests that Google has the momentum and is finally converting distribution into real gains. Now, it's also quietly challenging NVIDIA on the hardware side with its custom AI chips known as TPUs, and that could impact the entire cost structure, what we know of it today in the AI trade. Now, going into next year, there will continue to be questions around whether OpenAI can meet its own ambitions and obligations while competing with an incumbent, Google, that controls the entire pipeline. Something else I want to mention, Scott, there's this really interesting debate going on at the very highest levels of AI right now. It's playing out on X between DeepMind's Demis Hassabis at Google and Yann LeCun, who just left Meta. These are two of the most prestigious people in AI. Hassabis is arguing that today's scaled models, they're already on a credible path to general AI, while LeCun is saying the current approach is a dead end without a new architecture. So if Hassabis is right, scale, chips, infrastructure, those things keep winning. But if LeCun is right, a lot of today's CapEx is going to look premature, and the payoff gets pushed out. And that is really the central question on the bubble, right? Can we justify all of this spending?
Yeah. And maybe we don't know the answer for a while. Dee, thank you. Georgia Bosa, Chris, you say that the tech bubble does not pass our litmus test.
Yeah. So again, it gets back to something like JP Morgan banks, which is outperforming. Go back to late 90s, and the banks really underperform. Here, the banks are actually leading the way. Multiples that we're seeing, still not excessively high. You go back to late 90s, whether it's Oracle or Cisco, you're not seeing it. More importantly, let's go to, can you fund these risky endeavors? If you go to the credit markets, anything not named Oracle, you can go out and you can still fund. And so this market is still rather healthy. Valuations are not high enough at this level. We don't see the frothiness that we saw back then. And the commercial aspect is so much better now than it was in the late 90s.
So you think the Oracle situation or issue or whatever is idiosyncratic to itself?
That's what the market's telling you. The market's telling you that Oracle is very idiosyncratic. If you look at the credit spreads, if they came to the market, you'd be questioning how much can you bring to the market, at what spreads. If anything else, any of the other hyperscalers came to the market would probably not really think about it and digest more or less anything that they brought to the market.
You think we continue to have dispersion among these stocks? Yes, Alphabet is up 63% year to date. NVIDIA is up 37%. Microsoft is an underperformer slightly to the market, as is Meta, as is Apple, as is Amazon. Does this continue?
Scott, I'm going to say something that's not very popular, but I still think they trade as a basket because they do all have linkages to the same theme, but at different points of time, some will lead versus the others. And so I have clients that do mean reversion among the Mag 7, but I think that they're largely one complex.
Okay.
I hope we get mean reversion in the names that I own, because Meta obviously has a ways to go, but Amazon does too. Out of all the Mag 7s, that one to me has been the most surprising, that it just can't get out of its own way.
Do you agree with what he said, though, that you're going to get back to trading like a group? Because the stocks would suggest otherwise.
Yeah. No, I actually think that at any given point, you have a couple of leaders and a couple of laggards. And I think I'm betting on that the fundamentals are strong enough in the laggards that they will mean revert next year. That doesn't mean that Alphabet is going to fall 50%, but maybe it just trails for a little. Maybe it takes a pause. Same thing with Broadcom. As you know, I've said that before, that maybe it just takes a pause because it has crushed NVIDIA over the last year. And that's okay, but the fundamentals are still very, very strong, sound. Estimates are going higher. And when estimates go higher, no matter if these stocks take a pause, eventually the stock prices catch up with the earnings revisions.
Last point to you. How will these trade?
We like the software space. We think it's more selective. It's not over. And we think the best risk reward is in the software space.
All right, guys. Good holidays to everybody. Look forward to many conversations in the new year. Thanks for being here.